everybody. So today we're going to be looking at the last few ratios and financial indicators that we need to learn for the rest of this chapter in order to analyze and interpret our financial statements. So last time we left off with the debt equity ratio. It was the last one that we dealt with, and then we completed activity 4.2 and 4.3. Now we are going to be moving on to a few more new ratios and financial indicators which we need to know how to calculate. Okay, so the first one we are going to look at is what we call net assets. Okay, now net assets is basically a manipulation of the accounting equation. Our accounting equation says assets equals owner's equity plus liabilities. We want to calculate what is our net assets. How do we calculate what our net assets is or are? We have to take our total assets minus our total liabilities, and that will give us what our net assets is. So total assets minus total liabilities gives us our net assets. It also gives us, if we look at the accounting equation, total assets minus total liabilities is going to give us owner's equity. And that's why I say it's a manipulation of the accounting equation. The next one which we deal with, the next financial indicator, is known as the solvency ratio. The solvency ratio is quite important. It helps us to determine whether the company is solvent or not. And how we calculate the solvency ratio, we take total assets to our total liabilities. To total liabilities. This is how we calculate the solvency ratio. Total assets to total liabilities. So what are we trying to understand from this ratio is we are trying to see how many assets do we have in comparison to how many liabilities this partnership has. Is our assets in total enough to cover our liabilities in total? And we refer to the company or the partnership as being, is the company solvent, meaning yes, the company's assets can cover their liabilities, or is the company insolvent, meaning the company's total assets is not able to cover the company's total liabilities. Okay, so that's referring to the company as being solvent or insolvent. Then I'm going to be working through the example that you guys have in your textbook on page 312 to do the rest of the ratios. So just follow through with me on there if you like. The next one which we are going to have a look at, the third ratio which we are going to look at, is called our net current assets. Now here we were calculating the net assets, and here I'm asking you to calculate the net current assets. Okay, let's just make that a bit clear. So the net current assets, the difference between the two is here we want to know what is the net current assets, and there we want to know what is the net total assets. So all you're going to do here is you're going to say current assets, and the same thing like what we did above, minus your current liabilities. So current assets minus current liabilities will give you your net current assets. Okay, if we have a look at the example on page 312, our current assets for 20.2 is sitting at 114,800. That is made up of our inventories, our trade and other receivables, and our cash and cash equivalents. That's our current assets. We want to know what is the net current assets. So to get the net, we need to subtract from our current assets our current liabilities, which is sitting at 25,800 rand. And that's going to give us an amount of 89,000 rand. That means that after we have paid all our current liabilities off with our current assets, the partnership is left with net current assets worth of 89,000 rand, and this is their working capital. this is the working capital that they're left with afterwards, which is good. 89,000 rand is a good amount. Okay, the next one, or the fourth one, which we're going to look at, is what we call the rate of stock turnover. We spoke a little bit about this. The rate of stock turnover is how many times is this partnership purchasing stock? How many times are we replenishing stock? How many times are we purchasing stock? That is our rate of stock turnover. So we can either say how many times per year are we purchasing stock. And in order to calculate this, the formula is cost of sales all over average stock. Cost of sales over average stock. So cost of sales over average stock. Okay. In this case, our cost of sales was given to us. They told us that the cost of sales is 400,000. How do we calculate average stock? Okay. Remember, when we speak of average, we take what we have at the beginning plus what we have at the end and divide that by 2, and that's going to give us average. So in order to calculate average stock, what we want to do is we want to take opening stock plus closing stock, and we want to take all of that and divide it by 2. So opening stock plus closing stock divide by 2 will give us our average stock amount. So if we have a look at this example, let's look at our inventories. That's our stock. Inventories, that's our stock. In 20.1, our inventories were sitting at 78,900 rand. In 20.2, our inventories are sitting at 70,800 rand. To get average, we divide it by 2. Divided by 2. Okay. Then to calculate the rate of stock turnover, we take 400 divided by that amount, which will give us an amount of 5.34. And this 5.34 means that per annum, we are purchasing, or should I say replenishing our stock at least 5.3 times per year. 5.3 times per year we are purchasing or replenishing our stock. The next ratio which we are looking at is known as, or is called period for which enough stock is on hand. So period for which enough stock is on hand. You can also call it your stock holding period. Okay, period for which enough stock is on hand, also referred to as the stock holding period. And this is exactly the opposite of what we just did. So it's the inverse of the previous ratio, or the inverse of the previous financial indicator. So the previous financial indicator was the rate of stock turnover, where we took cost of sales divided by average stock. So if this is the inverse, that means here what we are going to do is we're going to take average stock divided by our cost of sales. Divided by our cost of sales. Okay. Previously, we calculated our average stock to be, it was 74,850. And our cost of sales is still 400,000. Now with this financial indicator, the question can either ask you to give the answer in months, therefore we will multiply this by 12. Or they can ask you to give the answer in days. If they want it in days, then we will multiply it by 365. So if you want it in months, you say times 12. And if we want the answer in days, we say times 365 to get days. If you calculate this, it will give you 2.25 months, or it will give you 68 days if you multiply it by 68.3 days if you multiply by 365. Okay, So either 2.25 months or 68.3 days. So what this tells us is when we purchase stock, how long are we keeping that stock for? How long are we holding that stock for? So according to our answer, when we purchase stock, we are keeping it for at least 2.5 months, should I say, or 2.25 months, or at least 68 days before the stock is sold. Okay, then remember I told you previously, if your rate of stock turnover is high, okay, that means that this financial indicator, the period for which enough stock is on hand, is going to be low. So if your rate of stock turnover is high, period for which enough stock is on hand will be low. And if your rate of stock turnover is low, that means that we aren't purchasing stock regularly throughout the year. Then your period for which enough stock is on hand will be high, because that means that obviously we are holding stock for longer periods of time. Therefore, we don't need to purchase stock often. Obviously, it's not good to hold on to stock for too long. As a partnership, as a business, and a sole trader, or anything, we want to be selling our stock quicker. Okay, we don't want to be sitting with dead stock. So it's good for the rate of stock turnover to be higher, and the period for which enough stock on hand will be lower. Obviously, it also differs according to the type of partnership or the type of business that we are dealing with. Okay, if you're selling groceries or consumables, stuff like that goes very fast. If we are a car business, then we're going to have a lower rate of stock turnover and a higher period for which enough stock is on hand, because obviously cars are not sold on a daily basis. Okay, and the next one we're going to look at, number 6, is known as our debtors average collection period. Our debtors average collection period. Okay, so what this basically means, or what are we trying to calculate by our debtors average collection period? What we are trying to calculate over here is how long is our debtors taking to pay us. Okay, so what is the collection period which we have for our debtors? How long are our debtors taking to pay us? How long are we taking, or how long is it until we receive the money from our debtors? Okay, remember, with every business, every partnership, every sole trader, you want to be receiving or collecting your money from debtors within at least 30 days. Not anything longer than that, because then debtors are taking too long to pay us, and we can run into cash flow problems. That's why we calculate this, so that we can see, are our debtors taking too long to pay us? And if so, what can we do to help them or to incentivize them to pay us on time? In order to calculate the debtors average collection period, we need to work out formula. So we take our average debtors divided by our credit sales. Remember, debtors do not relate to cash sales. Obviously, when we sell to our debtors, we are selling on credit. That's why we use credit sales, not just your total sales. We don't want the total sales, because that includes cash and credit. And debtors only relate to our credit sales. Again, over here, we can also multiply it by 12 if we want the answer in months, or we can multiply it by 365 if we want the answer in days. Okay, in order to calculate average debtors, again, you're going to take your debtors at the beginning of the year plus your debtors at the end of the year, divide that by 2, and that will give us our average debtors. Okay, so our debtors, according to this example, at the beginning of the year, our trade and other receivables at the beginning of the year is 30,000, plus at the end of the year, our debtors is sitting at 38,400, and you need to divide that by 2 over your credit sales, and they told us credit sales amounts to 342,000. Okay, now I took the total trade and other receivables, because the question tells you that your trade and other receivables consist of debtors only. So I already knew that my trade and other receivables only consist of my debtors, so I can just take that amount. So you're going to take the 30,000 plus 38,400 divided by 2, and then all over 342,000, which is my credit sales, will give you 36 and a half days, or we can look at it as 1.2 months. Okay, so this is relatively good. 36 and a half days or 1.2 months is relatively good. Remember, we said we want our debtors to pay us within at least 30 days. Okay, so at least 1 month. So this is relatively good. We can offer incentives for our debtors to pay us even earlier than this. Okay, we can offer them discounts. We can charge interest on overdue accounts. So there are incentives that we can offer. Then the last one that we look at, number 7, is known as our creditors average payment period. Creditors average payment period. So this formula is exactly like that formula, only now we are dealing with creditors. So you're going to take average creditors divided by our credit purchases. Okay, so now we're not dealing with sales, we're not dealing with credit sales, we're dealing with credit purchases, because obviously if someone is our creditor, that means that we bought from them on credit. So we don't want to look at cash sales. Cash sales has nothing to do with our creditors. We only want the credit sales. And then again, you can either multiply it by 12 or by 365. If you go and calculate your average creditors, you should come to an amount of 19,450. So you take your creditors at the beginning of the year plus your creditors at the end of the year divided by 2 will give you that amount. And then divide that by your credit purchases. Our credit purchases amounted to 78,818. And either multiply it by 12 or 365. Okay, they told us what our credit purchases equal to. So we didn't have to go and calculate that. And that will give you 2.96 months or 90 days. So this tells us that we are taking at least almost 3 months or 90 days to pay our creditors. Remember, we always want to pay our creditors later rather than earlier. So we want to receive money from our debtors at the earliest, but we want to pay our creditors at the latest possible time that we can, okay, without receiving any interest on overdue account. We don't want to be charged interest. So the latest possible time that we can pay our creditor without being charged any interest. Okay, and that's that.